All right. Well, welcome everyone. Thank you for coming. This is a presentation on the US economy. I'm Rob Larity. I'm the founder of Cognitive Investments, and I'm here with Jacob Shapiro, who's the director of Geopolitical Analysis. This is mostly going to be my deal today because this is a US focused thing, but there are some major international and global elements of this that Jacob will address. So the US economy, I'm going to tell you first what I'm not going to talk about, because it'll help clarify what I am going to talk about. What I'm not going to do here is put up 500 slides about everything going on. We could do that, but that would be pretty tiresome. We're really going to focus this presentation on what do we see that's different from the consensus? What are our takes, our views that are a little contrarian? And it sort of assumes that most people have a basic understanding of what's going on in the economy in terms of inflation and growth and those sorts of things. So that's number one. Number two, we're not going to focus so much on what's happening right this second. And I figure we can get into specific questions if anyone has them in the Q&A about that. But really in this, we want to focus on more of the medium-term things that we think people are getting wrong that will really help determine people's behavior, both as investors, but also as business owners and executives for the next 3, 4, 5 years, the big picture stuff to think about. All right. So here's what we're going to cover in this presentation. First, our first point, recency bias. If you're coming to a presentation like this, you're probably coming because you're afraid. That's often how people drum up audiences for presentations on the US economy. The problem is two things. First, we all have recency bias. It's within very living memory that we went through the 2008 crisis period. So historically, people tend to go around with a fear of the boogeyman. And we all need to take that into account when we're trying to analyze really what's going on in a situation. And then second, in addition to having the recency bias, there's always, the negative view always sounds smart. You're going to hear a lot of that nowadays with comparisons to the 1970s. Be very cautious with what the media says because they're not in the business of giving you good information. They're in the business of getting you to pay attention to them. Whoops. So big point number two we're going to make is this is not the 1970s. That's a very common theme. Everyone seems to be saying this and talking about this, especially because we had an oil price shock, which drums up a lot of memories. The more appropriate model to think of is 1948, not 1978. And we're going to talk about what does that actually mean, because not too many people remember 1948. Number three, inflation. The consensus is that inflation is going to be high and here to stay. We have a much more mixed view, and we're going to talk about the different components of that. Some of them international, some of them domestic, but it's a much more nuanced situation. And if your assumption is that inflation is going to remain high and steady, I think that is not correct. Number four, American households, believe it or not, are doing A-okay. It may shock you to hear this, given all the talk of inflation, dropping real wages, all the more recent data points. But on the longer term time horizon, Americans are all right. And then number five, US business and US corporate profits have just experienced the most extraordinary boom over the last 30, 40 years that has really taken place since the World War I years when we were exporting into Europe and basically minting money. So one of the final and perhaps most controversial points we're going to make is that corporate profits in the US are going to go down, or at least profit margins are going to go down for a number of different reasons. And we'll get into that in more detail, but the fat years that they've enjoyed are starting to go away. And what are the implications of that? Okay, so first off, recency bias. This is no surprise to anyone, but it's kind of interesting to look back and see. This is the history of United States GDP growth going back to the late 1940s. And this is the period that we've experienced in the most recent living memory. So the 2008 crisis was here, the worst GDP drop up until that time, basically ever, since the Great Depression. And then in 2020, you had arguably, or inarguably, I should say, the most traumatic shock in both directions to the US economy. So we've just gone through a lot of crazy stuff, but crazy stuff is not the norm. So you have to calibrate your expectations accordingly. Let's get into the meat of it. So why is this 1948, not 1978? So what happened in, whoops, here we go. Oh, I messed up my slides. So 1948, what was going on? Very similar to today. After the Second World War ended, there was an enormous boom in the consumer sector. Households were spending like crazy because they had been essentially locked down during the war. All the men had been away, et cetera, et cetera. And this boom was a demand shock right at the same time that you were getting a global supply shock because Europe was offline, literally in pieces. And what happened was you had a supply chain bottlenecks, inventory shortages, backlogs that were stretching out a mile long, and inflation began to skyrocket. So what happened was businesses were building up their inventories, and we're seeing the same thing today. So this is the current view of wholesalers' inventories in the US. So look at this spike. Can you see my mouse when I move it here? Yeah, so look at this spike most recently. Businesses are loading up on inventory, and part of this is volume and part of it is price because the inventories are high cost inventories. But right now businesses are carrying a lot of inventory on their balance sheet because they're responding to that big demand spike. For a tangible example of this, so here's Walmart. Look at how relatively steady Walmart's inventories were over the prior few years, and then these are its inventories now. And just so you know, from a seasonal basis, these spikes, these are quarterly numbers. These spikes for Walmart are the inventories that they carry before Christmas. We're not in the Christmas quarter right now. We're in the seasonally slowest quarter, and look at their inventories here, off the charts relative to where they were historically. So you've seen this huge inventory build in the US as all of these businesses rush to secure supplies. And it's the same thing that you saw in 1948. And essentially what you had happened was, just like today, at that point, the Fed, which was terrified of inflation, because they saw what was happening in the international scene, they saw what was happening in Europe, there was this great fear that inflation was going to skyrocket. And especially politically, at that time, you know, the Democrats were still in power at this point, and the biggest Republican push against the Democrats was that government was overreaching, that they were going to create inflation because, you know, all of the expansion they had done throughout the war. And it was a major concern for the Democrats and for the Fed. So the Fed at that time, just like today, really clamped the brakes on monetary policy and started raising rates. And as you can see in this analysis here, it was a case of locking the barn after the horse was stolen. Inflation had already spiked, and the economy, just like today, was starting to weaken and roll over right as the Fed was getting the most hawkish. And what you had as a outcome there was that you had a sharp and quick decline as all of the businesses unloaded the inventories, and then the boat sort of righted. So if you look at this chart here, this is this period we're talking about, where you had this quick, sudden drop, and then, you know, a fairly strong rebound after that. And you can see that here. So this survey just came out this week. This is the US Small Business Survey. And the light colored line here shows what are their plans for increasing inventory. So you can see after spiking here where everyone was desperate to get their hands on whatever they could because they didn't have enough stuff to sell, now this has really rolled over hard. And the desire to build inventory has turned into a desire to liquidate the inventories on the balance sheet, just like we saw in 1948. And here is another example. So this is the ISM manufacturing survey, which is sort of a forward-looking indicator of US manufacturing and sort of industrial businesses. And that's really coming off the boil quickly. This is the April data. The blue little bar here is the new orders. So new orders are really come off and are probably going to go negative as if current trends hold. So you can see this response happening. Okay, so inflation is a mixed bag. I want to get into this, and part of this is getting to why this is not the 1970s. So when you think of the 70s, everyone thinks of high and sustained inflation, which is what we experienced. What people don't often talk about is the demographic impact on that. So this shows a chart of the growth in the 25 to 54-year-old population each year going back to the war. And this huge pig in the snake here in the whole center of this chart, these are the baby boomers entering the workforce. So this really started to accelerate, and you have to look at the second derivative here. So acceleration started right in the late 60s as the baby boomers who started being born in 46, went into their college years and entered and started looking for their first jobs. And if you go back to the time period and actually reread what was going on there, during the Nixon administration, there was a huge fear of unemployment. And all of these people were entering the workforce. They were looking for jobs. They wanted to own a home. They were having children. They wanted cars. This was a massive social need. So you had this demand shock for everything. And people blame too loose monetary policy for driving inflation at the time. Well, there was a strong political reason to keep monetary policy loose because the government was terrified that this enormous demographic bulge was going to end up without jobs, without human capital that they can spend in later years. And you can argue about whether that was a good idea or a bad one. I think the baby boomers ended up doing pretty well, but don't ignore this demographic bulge in terms of what drove inflation. And if you were to look at a chart of inflation, you can see it really picks up here and then starts to decelerate right as this starts to decelerate, the second derivative in the early 80s when Volcker comes in. So that was the situation then. That was a major driver of high and sustained inflation in the US. What is the situation now? Well, here's the total population growth year over year of the US. And you can see during the COVID period, obviously we've had a substantial drop in the rate of growth, but this is continuing a longer trend that's been going on really for 15 or 20 years, where growth has been sub 1% since 2000. And that's a major change. The biggest driver of inflation, literally speaking, is housing. It's 35% of the total CPI number. And the biggest driver of housing is how many human bodies do you need to fit into a space? So when you think about inflation, you need to think about demographics, you need to think about these issues. And the demographic picture does not appear to be getting any better from here. So in fact, it's getting worse. Here's the fertility rate, which started dropping about 15 years ago. I'm not sure what this low period was. I think it was primarily inflation driven would be my guess. I don't know if anyone has any any knowledge or background there. But we've been trending down for 15 years, and that has gotten worse under COVID. This data is only through 2020. We really only have preliminary data, but the initial numbers I've seen suggest that there was an initial big drop in births and pregnancies during COVID, and now we're getting a bit of a rebound, but still this trend is downward and it's intact. So right now we're only giving birth to about 1.6 children per woman in the US, which means we're not replacing ourselves in the US, which is partly why you see this number here. And at the same time, we're dying at a faster rate. It was COVID was arguably the biggest and scariest event that we've experienced in the United States for a very long time. And in 2021, I believe the final estimated count was that 400,000 Americans died of COVID. Well, this shows the number of drug overdose deaths per year, which in 2021, the estimates just came out. It's estimated that overdoses are now killing over 100,000 Americans per year. So health indicators are not going in the right direction. And I don't have a chart for this, but it's sort of something that everyone knows anyway. If you look at the demographic profile, the first baby boomers who were born in 1946 are now 76, going on 77 years old. The US life expectancy is 78. It's anyone's guess, what the life expectancy for that particular cohort is going to be, but there's no question that the fat part of the demographic snake is moving into the period when you're going to see mortality rates go up. So there's really very little reason to expect this to change anytime soon, which is bad in many ways, but from an inflationary standpoint, it's deflationary. Fewer people, literally fewer mouths to feed, fewer bodies to pack into apartments and homes. So speaking of homes, housing prices have been the biggest driver of inflation recently. So what's that all about? The issue with housing, and this is not a contrarian view, is that inventories for sale are very, very low. And people aren't entirely sure why that is. But you can see this is the number of homes listed for sale at any given time throughout the course of these months shown below. So we were running at a pretty steady, 1.2 to 1.4 million rate heading into the crisis. And since then, people have not been putting their homes up for sale. It's not entirely clear why, whether that's partly because they know the values are going up. Is it partly because people are scared to move because of COVID? Is it some other reason that we don't know about? It's hard to say, but this has been the biggest driver of home prices appreciating because there's a squeeze happening in the market. There aren't enough homes to buy. Everyone knows this. You can read the newspaper. I'm sure you've heard plenty of anecdotes about people desperately scrambling to buy homes as soon as they're put on the market. Well, that's been the biggest driver of home prices. That appears to be starting to heal. Home inventories for sale on a year-over-year basis, as of the most recent data a few weeks ago, are no longer decreasing for the first time since the pre-COVID period, which is a big deal, a very big deal. So something is causing this problem to begin to heal. And the underlying situation is that there are many, many millions of homes in the US. I don't have the number here, but there's something like 130 million dwelling units in the United States. So when you think about 400,000 for sale, what a tiny proportion of the total number there are, and the number of potential homes that could be put on sale in apartments and condos and things like that. It's shocking when you think about what a little change in supply can do. The other thing to keep in mind when it comes to home prices is new home building. So there haven't been that many new homes hitting the market recently because there have been construction shortages, shortages of labor, of materials, that kind of thing. That is getting fixed with a vengeance. So this chart shows the total number of housing units under construction in the US, going all the way back to the early 70s. There's currently 1.6 million new homes being built right now. Those homes, at some point, they may be delayed, but it doesn't take that long to build a home, even if there are delays. At some point, those homes are going to hit the market. That's going to really help loosen up the shortage of homes to buy and exacerbate if you do get, supply hitting the market, whether that be because baby boomers are downsizing, baby boomers are moving in with family, baby boomers are dying. That's going to be a major supply bolus in the next few years. So medium term, we're fairly bearish on house prices at the national level for these reasons. So I'm going to hand it over to Jacob a little bit because we talked about demographics, we talked about housing, and those are very long-term, durable sorts of things. But one wild card that Jacob in particular has written a lot about has been food. So Jacob, why don't you give your view on sort of the medium term and the long-term outlook for food price inflation and how that might affect particularly the American economy?
Sure. I mean, thanks, Rob. I'm also just digesting, to use a terrible pun, everything that you just said. But I think there's two ways to look at food. And for us in the United States, it's largely going to be an issue of inconvenience and higher prices. We're going to be spared some of the worst things that are going to happen in other places. I should also say that food is inextricably linked to weather. And nobody, whether it's, nobody has created a thing that allows you to reliably predict weather. And probably won't anytime soon. So a lot of what's going on with food prices is going to be affected to weather. But look, one of the things that has been happening really since 2008 wasn't just a global financial crisis. That was also the last time we had a serious spike in global food prices. And the reason for that spike was really because of a generational drought within the Middle East. And that was why the Arab Spring happened, because those supplies were so disrupted, and then it sort of mushroomed throughout the rest of the world, and we saw those changes in markets, but the political effects were really being felt in the Middle East. What's happening now is sort of a global version of that, and it started with the COVID-19 pandemic that really seized up supply chains. And a lot of whether it's fertilizer inputs or food itself getting to market, I mean, global supply chains have become a much bigger part of food trade kind of going forward. But for the United States in particular, weather just hasn't been particularly good the last couple of years. And so yields in places like for instance in Texas and Oklahoma right now, terrible weather. One of the reasons cotton prices are up so much is because they're just having a lot of drought. In South America too, this is one thing that we've talked about for a long time, but for those who aren't familiar, in South America is going through the worst drought in Brazil's recorded history. That was what the Brazilian meteorological entities said, kind of 6 months ago. And these are major producers of things like corn, like wheat, et cetera. And when food prices go up like that, US producers like to export abroad. Those farmers like to make more money rather than selling locally, because that's the way the system is really set up right now. And we pay more for food prices in general. So the food inflation picture, it's actually gotten a little bit better in just kind of the last month, which may be counterintuitive. There's been a slight drop in the UN food price index for April. We're still at record highs, even with that drop. And the problem going forward is that you've still got a lot of weather-related variables that probably aren't going well. So Brazil, for instance, I already mentioned them, they keep revising their yields down because the weather there hasn't really improved. India, which 2 months ago was bragging about how they were going to be the savior for global markets by allowing their wheat stocks and other grain stocks to go on the global market, they've had a heat wave with temperatures, between 110 and 120 degrees Fahrenheit, and it's not letting up at all. And they're already revising their wheat yields down. So when you kind of look all around the world, you've got all these countries that are looking for food, that are willing to pay higher prices for food. And you've got US producers who are constrained by weather and by higher input prices, and who are maybe looking to export abroad, and they see those higher prices, and you get sort of that disjuncture within the United States itself. I would also say, and this is, Rob, something you and I were talking about yesterday and connects to some of the things you just said, US infrastructure around food is also not great. We have, I think it's like, there was a study done by some researchers, I think it was at the University of Illinois, but I'd have to double check myself and can share the study with anyone who's interested in getting super nerdy on this. But they did a study and they looked and they found 9 key sort of supply chain choke points within the United States itself, that if any one of those supply chain choke points went offline, food distribution in the United States would also get very rough. And we're already seeing the way we've experienced some of this, I think, with COVID. Probably some of your favorite products weren't around. This whole baby formula situation is sort of that's the shortage that's happening in the United States. This is part of that. You have these weird pockets of the market, especially in the context of COVID, where you had surging demand and then less demand and then less production and supply chains not working so fast. So all of those dynamics are still there going forward. I think and again, the United States, for us, this is inconvenient. It is driving prices up further. If you look at the CPI print from this week, food prices are up 10% year on year. Energy prices are up 30% year on year. That's a lot. But the United States is looking better than most of the rest of the world. We have cheaper energy than most of the rest of the world. Even with our weather problems, we can grow food better and cheaper than most of the rest of the world, which is why what feels like inflation and food price spikes here is leading to government change in places like Sri Lanka, or protests in the streets in states of emergency in places like Peru. So the grass is not really greener here. We have in the United States, we have our problems, but our problems are actually relatively less than kind of where other countries are less compared to what other countries are facing.
Yeah, I mean, the other thing about food and energy also, just thinking about oil and natural gas, is they're cyclical markets. So, they have the capability to respond in terms of supply to price signals with some delay, but to expect that food prices are going to remain high or energy prices are going to remain high and there's going to be no attempt to increase supply, is just not realistic. So I think probably higher than average, but very volatile is the way to think about food and energy combined. Is that a fair summary, Jacob, would you say?
Yeah, and I'm glad you said that, because I sort of neglected maybe the most important thing I should have led with, which is that the United States is not alone in that. If U.S. farmers, energy producers, everybody has been betting on China as a market for consumption. And the only reason that oil is not higher right now, and the only reason that food prices haven't exploded, is because China has shut down due to COVID-19. That's going to be bad for supply chains and for manufactured goods and industrial products and all those other sorts of things. But there are also silver linings to that. So shipping is actually already getting quicker. Some of those blockages that were in Western ports, those are resolving. But the other part is that it is actually decreasing commodity prices, whether it's energy, whether it's food, because when you have an actor as big as China not consuming like they were, suddenly you're putting a ceiling on where prices go. The bad news is, like, China's going to get it under control. We can argue about whether it's going to take them 2 months or 6 months or 10 months, and whether they're going to be able to do it without over 1 million people dying from COVID in China or overwhelming the healthcare system. Those are all very important questions, but at some point, China's going to come back online, and they're going to start consuming again like gangbusters, and all the stuff that they've imported over the last 6 to 8 months to prepare for this situation, they're going to want even more of that. So I say all that to say your point about volatility is exactly right. And we've backed ourselves as a world into this situation. And it started with COVID, where you had a massive drop in demand, then a massive increase in demand. Now that China's sort of different, on a different cycle than the rest of the world, they're going through their cycle. And so we're going to get another massive drop in demand, and then another massive increase in demand too. And I think that's one of the reasons markets are so volatile, because you have an uncertain situation, you have a pandemic, you have great power competition, but you're also just the sort of year-on-year comparisons, they're not making sense anymore, because every year is different and there's some new thing sort of happening at every juncture. So that's also one of the ways I would kind of point people when we're thinking about not just the US economy, but the global economy in general, for anything that could be labeled a commodity. Right now, commodity prices have taken their foot off the gas because the Chinese aren't consuming. As soon as the Chinese start consuming like they were before, you could probably see another leg up, because all those same dynamics that put us at record high food prices and oil at 110 a barrel, all that stuff's still in place. That's not going anywhere.
Yeah. Just as a brief aside, if anyone has any questions they want to put in the queue while we're talking, and then we'll get to them at the end, you can click the Q&A button at the bottom and type it in there. I'm sure you know the drill by now. Okay, so that's inflation. Let's just talk quickly about US households, because this has been a major focus of discussion in the media around inflation and everything going on. And our somewhat non-consensus view is that US households are doing fine. Not to be glib, but here is the view of US households' debt as a percentage of GDP going back over the last 30 years. And you can see, after levering up to the hilt at almost 100% of GDP during the the housing crisis and then the lead up into the 2008 downturn, US households have spent the last 15 years almost delevering their balance sheets and paying down their debt. So we're in a pretty good place on that measure. Part of that is because the government has amped up its own debt. So when you think about debt levels in the economy, everything has to balance. Debt is just negative savings, right? And when you have positive savings, your debt goes down. So US households have increased their savings over the last 15 years and then some. And the corollary to that has been the government decreasing its own savings. So this is US government debt, which has been rising since the financial crisis in 2008, and then had an enormous bolus during COVID. This has been the price that we've paid to delever the US household. So US households are sitting in a good place from a balance sheet perspective, how much debt they have. So how big is your mortgage? But if you look at the actual cash flow considerations, it looks even better. This is the US household debt service ratio for mortgages. So what this means is what percentage of your household's income goes towards mortgage. And this is not 3%, because obviously it's more than that. This is a ratio that's calculated by the Fed. But relative to history is the way to look at this. And what's happened is that the obligation to pay the carrying costs on your mortgages has collapsed. And primarily that's because everybody and their uncle has refinanced into much, much lower rate mortgages in the last 10 years because interest rates have been very low. And you saw another spike of refinancings during COVID when rates, in many places got sub 3%. That's not going to go away as a benefit for a very long time. Mortgages are 30 years on average, as you know. So this ability to lock in low rates is going to be a huge boon to the US consumer relative to where they were. Look at where they were in 2007. This was when all the adjustable rate mortgages began kicking in, by the way. And then this is just a broader look at the financial obligations ratio. This includes not just mortgages, but also auto loans, auto leases, rent if you're not a homeowner. So what is the total rent obligation relative to your income? So relative to history, and especially relative to the pre-2008 period, we're at decade lows here. So the US consumer, the US household has money to spend in a way like that they didn't before. Let's move on to business. So the fat years are over. What is the problem with US business? And how do you define problem and for whom? Here is the level of US business debt as a percentage of GDP. So you can see as the government was levering up its balance sheet and taking on debt, and households were reducing their debt, businesses were going in the opposite direction. So businesses were responding to lower rates, lower interest rates by adding more and more debt. And this is pretty extraordinary because if you look at this number, we're at 77% of GDP right here. This is near a cyclical peak for GDP. So these rates here, where you got up to 75 and 08, this is at the worst of the crisis. So if you think of it as a division, the denominator, GDP, was at its bottom here, which is why this looks so high and this looks high here in the 2000 recession. We're at 77 right now, and the economy is going, or has been until very recently, going gangbusters. So on a cyclically adjusted ratio, the amount of debt that businesses are carrying is very high, higher than it's been really since the 1970s. The problem for that is, unlike consumers who are refinancing into these 30-year mortgages, and that's by far the biggest component of consumer debt, business debt on average is much lower duration. So most businesses are issuing bonds that are maybe 5 years, maybe 7 years. I don't have a weighted average number in front of me, but it's somewhere along the middle of the yield curve. So this is problematic because business has to reprice much more rapidly than households do. So this is going to be a problem. Now, it hasn't looked like much of a problem in recent years, because businesses have been extremely profitable. So it's funny, you know, as many of you will know, there's a big part of the hedge fund world and the investment world that focuses on distressed debt investing. So typically the people who do that are lawyers and have a legal background, and they understand workouts and things like that. And they've had nothing to do for 15 years. They've been sitting on their hands because businesses haven't been going bankrupt. And a big part of that is this. This shows the business sector's profits as a percentage of GDP going back to the early 70s. So you can see we troughed in the early 80s, which was the bottom of the stock market. The generational bottom was in 1982. And since then, we've been in a 40-year uptrend for business profits. And I just want to draw your attention, if you look closely at this. So here, you know, you could see these are the economic cycles, 2000, 2008. And then here we had a mini, I wouldn't even call it a recession, but a slowdown in 2014, 2015. So you saw business profits come off here. But the thing to really note here is this, because business profit margins never rebounded back to their levels from here after the 2014-15, you know, slowdown took place. So the economy was very strong during this period, and businesses did not experience the same kind of margin expansion that they saw previously. And that's a major warning sign, because right now it's just a mess, because you had COVID, and then after COVID, profits have exploded because the government deficit was enormous and they were pumping money into the economy. But my view and our view as a firm is that this is starting to roll over. Business profit margins probably peaked shortly after the financial crisis of 2008. And if this trend continues, then you should expect profit margins to compress. And that's intuitive as well, because if you pay attention from a bottom-up standpoint to what businesses are saying, all of the discussion is about, we have to increase our investment, we have to replicate our supply chains, and we have to move them, we have to build resiliency into our supply chains, we have to carry more inventory because we're not sure that we can get it when we need it in the same way that we did 10 years ago. Labor is more expensive than it was. Freight is more expensive, et cetera, et cetera, et cetera. That is the sound of profit margins getting squeezed. And that doesn't appear to be ready to turn around anytime soon. So what has business been doing for the last 10 years? It's been an extraordinary time. So if you look, here was where we reached peak corporate profit margins for the US business sector. That was also the time when, as a percentage of GDP, businesses were investing less than they ever had before. So you saw, this shows the percentage of business investment compared to nominal GDP, and obviously it moves around with the different cycles. But the thing to note here is, if you were to take an average, put a horizontal line through this from cycle to cycle, the average here is probably somewhere north of 22%. And even though the economy rebounded after the great financial crisis of 2008, business never got anywhere close to that again throughout that whole period. And this was the time when profit margins were expanding. So what you see here is businesses were essentially coasting. They were not aggressively investing. This was the period of coziness, of cozy monopolies in many cases. And everyone knows about the big tech companies and those sorts of issues. But across many aspects of American business, there was a lot of coasting going on, not much investment at all. And the problem with, or I shouldn't say the problem, the dynamic around investment is that it usually constrains your margins in the short term, you know, for a greater long-term benefit. But when you're riding your existing assets and squeezing more cash out of them, that's good for your margins in the short term, but at the expense of the longer term. And the thing to notice here, very interesting, is this appears to be changing. So despite what you've seen with, you know, business confidence rolling over after 2018, which we're going to get to a little later, business investment is beginning to ramp up. And you can see this out there in the marketplace. You look at companies like Amazon saying, you know, we're going to be building out data centers and accelerating our spend on cloud. You know, that's a huge source of fixed investment, the whole IT sector. You look at a company like Ford saying, we're going to spend $50 billion to transition to electric vehicles and build new plants. That is the general trend that you're seeing. Businesses are getting out the pocketbook in a way that they have not for the period since 2007. And that is really, really important. And one way to think about that is, you know, what are the drivers of business investment? Well, businesses tend to go through periods like this when there's stagnation, when there's not much that they feel compelled to invest in. And if you look, not to get too wonky and academic, but this is kind of an interesting chart from Carlota Perez, who writes about technology cycles. And what she says is, when you have a technology cycle, you have this big bang event that draws everyone's attention to a new revolutionary technology that's going to be ubiquitous. And then you have the early adoption period. And then, you know, you start to get installation of the technology. So if you think about the current technological revolution, which is computing, the big bang would be the creation of truly miniaturized semiconductors in the early 1970s. This period would be, you know, from the 1980s through the 1990s. And then now we're entering this period, which she calls the deployment period, which essentially means everyone recognizes that they have to use this new technology, whether it be electricity, steam, steel, computing, and everyone rushes to go out and implement it. And that's what we're seeing right now. And it's not just Amazon and Microsoft and Google and companies like that building out these enormous cloud centers. It's not just telecom building out 5G. It's ordinary businesses that are building out e-commerce capabilities, for example. That's really a post-COVID thing. If you look at companies, sporting goods companies, apparel companies, they are investing massive sums in warehouses, in e-commerce capabilities, in shipping, in digital capabilities. We've all kind of grown up with computing and phones and everything all around us. Prepare for that to accelerate, because these businesses are finally making the investments at a broad scale, not just the early adopters, not just the IT sector, but everybody. And that's going to really change the face of the experience that we have every day interacting with businesses as consumers and as business people ourselves. Now, the downside of that is that investment is bad for margins. And you can see this. Just to give an anecdote, Amazon just reported their quarterly numbers. They had their first negative profit quarter in, I think, 10 years. That's a sign of what's to come. More investment, lower profits, the need to keep up because everyone sees where the technology is going. And I threw this in here because I thought this was interesting, and I don't know if anyone has any thoughts. It's more of a question than a statement. So you can see this is the Small Business Optimism survey, which just came out a few days ago. And small business is very pessimistic right now, which you can see on the left side. This is the general survey about conditions. So, we're as pessimistic as we've ever been, excluding true crisis scenarios or the Gulf War or the 2008 crisis period. And yet, I thought this was interesting because if you look, this is the uncertainty index. Uncertainty, which basically means, what do you think about your business outlook and about policy, fiscal policy, trade policy, things like that. Uncertainty went off the charts during the Trump years. And when we were calling into question a lot of kind of the fundamental relationships of the US and the world, trade relationships, import tariffs, those sorts of things. And interestingly, in the more recent period, that uncertainty index has really come down a lot, which you would think, my God, there's a war going on, prices are going all over the place. It's totally bananas right now. Why isn't uncertainty higher? But it's falling. And I find that really interesting. And I wonder if it says something about the perceived ability of government to do anything big or weird right now, given that inflation has chastised them a little bit. I honestly don't know. And I put that out there in case anyone has any comments. So those are the main parts of the presentation. Here are the takeaways that I would take from what we've said here today and sort of our differentiated views. First, we're optimistic about America's economy, probably more optimistic than the last 10 years. And it really gets back to the two things that I think are most important, households being in a good position, as we talked about, and even more, businesses ramping up investment. And if you think about the sorts of things that businesses are investing in, energy transition, e-commerce, digital capabilities, 5G, AR, the metaverse, whatever, take your pick, space. This is good for society in a way that businesses putting on the handbrake was bad for society for the last 15 years. So prepare for great things ahead as a consumer, as a household, as a person. The corollary to that is we're not optimistic about the profits of US business. US business has been coasting on the momentum of the prior several decades, and that is now apparently starting to end. So if you believe that this trend has indeed started rolling over here, and once you get past the COVID crazy volatile period, that this is going to continue downwards, then you should not be optimistic about the profits of American business. maybe their revenue growth, but not their profit growth. So the two takeaways that I would have is, if you are running a business, you should expect volatility. You should expect things to be crazy. Think of that 1948 example that we gave. The market was like a boat on the water that had been tipped, and it's going back and forth in a very volatile way. That's how you should think of the economy, both in terms of prices, in terms of growth, in terms of policy. So the number one thing, I always loved this phrase, but there's the great venture capitalist, Bill Janeway, wrote in his book that the two things he recommends to early stage companies are: always keep cash and control, always value liquidity and cash on hand more than you think you should, because you're always going to be too optimistic and you're going to want it when you don't have it. And control, always maintain the flexibility and the ability to move away from areas that are dangerous and difficult and into areas that are better. Because given the volatility that we're seeing, those two things, cash and flexibility and control, are undervalued by the market right now. And if you're a business, that's what you want. You don't want to be stretching yourself right now. You want to be tight and opportunistic. And if you're an investor in the US, I think the big takeaway is, if you're buying US corporate equities, passive is out. The tailwind of corporate margins expanding and corporate profits expanding more broadly, that appears to be over. And at the same time, this surge of investment that everyone is making in all those areas that we just talked about, including digital and computing and IT, that's going to create winners and losers. Things are up in the air in a way they have not been for the last decade or two. And that's really exciting, but it also means that there's going to be big winners and there's going to be big losers. So you can't just ride the broader wave. You need to be thoughtful about anything that you're investing in, whether it's going to be on the right side of that trend or not. And paradoxically, some of the businesses that look the least profitable in the short term are going to be the best investments, because they're the ones that are doing what they need to do to get to the other side and lead as this transition is happening. So those are the big things. We'll go to Q&A and see if anyone has any questions. Sure. So first question for Jacob. Any thoughts in this context you've described, particularly Jacob, on food, on the scenarios for refugee movements and large movements of people?
I see it's from David. Hey, David, nice to see you. Or nice for you to see me. I can't see you. Yes, I mean, I think we're already seeing little small pockets of this, and I think it's going to get much worse. I mean, the thing that I've been reminding clients and folks that we've been talking to in the last couple of weeks is that, think of what happened in 2014 and 2015 with the Syrian civil war, and you had roughly 1 million migrants from North Africa and the Middle East start to flood towards the European Union, and all the follow-on political effects that happened as a result. So for instance, Brexit, polls for Brexit started to go up right around that time period, because if you remember, Angela Merkel was lecturing the Brits about how they should be morally upstanding people by accepting more migrants into their country. And the Brits did not like being lectured by the Germans about morality, and Brexit got a big tailwind as a result of that. And we've already had a lot of migration within the EU itself because of the Russia-Ukraine war and the things that have been happening there. One of the things that Rob and I have been watching most closely at CI is the ongoing political violence in the Democratic Republic of Congo, which I was just writing up this week's SITREP, which has gotten even worse. And there was actually an attack by a militia on a mine for the first time in this entire process just this week. And so when you think about how that's, and then in addition to that, the DRC was also put on as the #1 country for food insecurity on the World Food Program's report, with over 20 million people in danger of extreme food security. You've also had the UN in the past couple of weeks warning about the prospects for famine in East Africa. I mean, it's like we're running through all the plagues in the Old Testament right now. We haven't had a famine yet, so let's just add that to the picture. But Somalia, Ethiopia, some of these countries that have failed states and even civil wars that are still raging within them, they are now looking down the barrel of serious food shortages. So we haven't really seen the migration shoe drop yet. But whether it's in East Africa, whether it's in Sub-Saharan Africa and the DRC, whether it's in Central America, South America, apparently the car alarm outside agrees with everything I'm saying. I don't know if they could even hear that, but a car alarm just went off outside. But Central America, South America, all again talking about food insecurity crisis. So when you're looking at migration flows, I think relative to the disruption that we've seen in food, we're still at the very beginning. There are little whispers of just how bad it could get, and unfortunately, I think it's going to get a lot worse. And countries and places that are areas that are desirable for migrants to go to, you can already see them getting prepared for that. So the EU is already doing that. One of the big things that the US government is trying to deal with is increased rates of migration from Central America. I mean, if you add in one or two weather-related things or a storm in the big Atlantic hurricane or something like that, and that hits Central America, suddenly migration rates could explode through the roof. So I think you're right to identify it as something to be worried about and as something that could actually affect these economies going forward.
Here's a related question for you, Jacob. Is an export ban on food, oil, and any other volatile commodities a possibility in the US? What do you think?
An export ban on food, oil, and other volatile commodities. Is it possible? I guess, but I would rate that as very unlikely, and I'm not sure what power the executive would be able to do that under. I mean, the United States is not Argentina. The president doesn't just get to decide that we should no longer export things and that's how it goes. That's one of the different things about the United States. And for better and for worse, I mean, the United States is about trying to have frictionless trade and frictionless exports. Even in the context of the US-China trade war, for example, the US never restricted exports of things like food and oil. They wanted the Chinese to buy more of those things. Most US governments actually want to encourage those exports from that sense. So, I mean, I guess maybe we could, the other part of this is that I think to do something like that, you'd have to have both houses of Congress. And as we've learned over and over and over again, the Democrats may technically have a majority on paper, but they don't have a voting majority for really important things and controversial things. And when what you're talking about would be incredibly controversial. And I think there would be a lot of blowback. So I don't think we're at a scenario yet where you would see those types of export bans and things like that. The only reason I'm hesitating in the answer to your question is oil, because energy is a place that the United States has done that before. And I don't think that US law has caught up with the paradigm shift in terms of US energy production and the US becoming a superpower. Now, I remember when the pandemic started, technically, the Texas Railroad Commission can still limit oil production in Texas. They haven't done it since the 1970s because there's never been a reason to limit production. They want as much as possible, but there are laws in the books from an energy perspective for the United States to do that. But again, it's very hard for me to imagine that Biden has that kind of leverage and pull and legitimacy within the system right now to do something like that. So no for most commodities, and I can't tell you no for sure on oil because technically I think it's possible, but I would be very surprised if that happened.
The only thing I would add on that, Jacob, is, isn't it true that the US agriculture sector is extremely influential, extremely well organized, and the people who get hurt by high food prices and might be calling for an export ban would be much more dispersed, much more focused in lower income consumers who don't, really have a strong spokesman, especially on those issues. It's not clear what that policy path would necessarily be and how it would overcome, the entrenched position of big farmers who are export powerhouses, right?
Yeah, well, I mean, this is actually one of the ways I think US food supply chains are probably going to change over the next decade. They're just not going to change that much. But right now, the way a lot of these farmers make money is that they're exporting abroad at higher prices. So rather than thinking in terms of, sell regionally and locally, a lot of what's happening in the United States is it's agriculture at scale, and you're selling that stuff abroad, and then that's how folks are making money. Every U.S. Ag Chamber of Commerce urges U.S. farmers to sell more, export more, get more abroad, and things like that. I think part of what's happening in the world right now is we're going to have to go more local and regional for a lot of different reasons, for environmental, for the cost, for the price and availability of inputs. I mean, I think that's a very, very sort of long-term trend. But in the short term, you're exactly right. Like most of the U.S. ag sector, if you took out exports from underneath them, it would be cataclysmic. I mean, any government that did that would be would not last very long in the United States, I don't think. So
let's go to this one because it's related. So could you please go deeper on Central American migration north? If the government is already preparing for this, what about, what do you do as a business or an investor? Why don't you take the macro and I'll take the micro?
Yeah, well, there's a couple different parts to this, and not all of it is negative. So the first country that is going to face problems with this is not the US, it's Mexico. And this type of migration, it can be good and it can be bad. I mean, it's bad in the sense that you might have more competition for jobs. The countries might not have the infrastructure to handle these sorts of things, but it's also usually you're getting human capital, people who are well-trained or who have experience in things. And if you can integrate those types of people into your country, it can actually be sort of a big boon. The problem, I think, with the Central America issue, though, is that immigration is such a political hot button issue in the US. We just don't have the infrastructure to handle the level of migration that is coming at us. And the way that the Trump administration solved this was they made a deal with some of these Central American countries, and they just kept sending people back. It was like catch and release sort of thing. And the Biden administration is sort of caught in between its own principles. It doesn't just want to do that, but there isn't any kind of clarity from a legal perspective about a path to citizenship. There isn't enough infrastructure on the border to take care of the flows that are coming through. I think this is actually, you might talk about this in your answer, Rob, and that's reflected a little bit in CI equity, I think. But so I think that sort of in general, those are the ways to think about it from a macro perspective. And I think the other part of this is to think about which countries in the region are actually not going to face this sort of thing. So if you're getting exodus from a country, that country is probably not a good investment long term. So look at the countries that people aren't leaving in droves. So, we talk a lot about what's wrong with El Salvador and what this crazy dictator is doing here, and what is Ortega doing in Nicaragua. It doesn't sell as many newspapers to say Costa Rica is great and just had a really very easy, chill political election with a center-right pro-business sort of government going to town, and they have good infrastructure, there are success stories in here if you look past the migration. And parts of Mexico are actually part of that. Parts of Mexico are doing very badly. Other parts of Mexico are doing very well. So that's how I would answer that question from a macro perspective. But I'm curious where you would take that from an investment perspective, Rob.
Well, first I have a question for you, Jacob, just on the Mexico thing. I'm curious, how would you evaluate their ability to incorporate new migrants? Like, where are the migrants going within Mexico? I know we've talked about this divergence between the areas that are doing very well and the ones that are very much not. How is that playing into that? Do you know? I'm curious about that.
Not great, but I mean, most migrants want to get to the United States, which I know is frustrating for some in the United States, but it also is a testament to no matter how bad we think things are in our own country, for most people, the United States is still a beacon of opportunity and things like that, and people want to get there. So that's a challenge for Mexico. I don't think Mexico has done a particularly good job of integrating those migrants into their own system, and it's actually strained the Mexican political system a lot. It's why you get Mexico and the United States governments often coordinating on migration, because it's a similar level of problem for both Mexico City and Washington. So they end up coordinating because they're trying to make the problem or at least operative for all of them. So no, I don't think we can fairly say that Mexico has done a great job of trying to figure out how to integrate these migrants into their economy. It hasn't done a good job doing that.
And then on the micro, so the question was, how does a business person or an investor think about this or prepare for it? as a business person, if you're running a business, I mean, I hate to say it, but unless you're right on the border and you're exposed to, significant volatility around the actual process of people coming in and those sorts of things, in general, more migration is a good thing. We're having a labor shortage, which may or may not be quickly getting alleviated right now. But the fact is there aren't enough low-skilled workers in the US at the moment. We've really throttled incoming unskilled migration in the agricultural sector, especially. And on the whole, that's a positive for you as a business owner, I think. As an investor, from a macro standpoint, I'm not sure if there's any big takeaways. From a micro standpoint, one interesting sort of way to get exposure to this theme. So if you do have negative exposure to this in your business or negative exposure to it in your investment portfolio, one of our largest positions at CI in our sort of focused equity part of our business is a company called Core Civic. CXW is the ticker. And they're essentially a play on migration. So 35% of their business is with ICE, the immigration services, and they provide the facilities where ICE has to house people while they process their asylum claims. And for various reasons, Core Civic had been, sold very heavily and sort of left for dead. And on top of everything else, the Trump administration had put a halt to actually housing people and had implemented the Title 42 turn them away at the border policy, essentially. And it looks like that's going away. So if you want to have something that's very much leveraged to migration flows from the north, that's a good way to play it. All right. One question here. I want to talk about this question. Do you see quantitative tightening impacting commodities and commodity producing stocks? And then, the question is about China coming back online and how that might affect commodities and commodity stocks. So I think the question here is, what is our view of the risk reward of owning commodity oriented stocks right now? I think the short answer to that is we don't like them right now. China may drive a rebound in commodity oriented stocks. And I'm talking about hard industrial commodities, not food, not energy, just cyclical industrial related commodities like steel, copper, things like that. Right now, if you really look at what the market is telling you, the market is telling you that demand is outweighing supply, US demand, European demand. The prices of industrial metals have started to roll over in the last few weeks after surging post-Ukraine. And a lot of investors were hiding in those stocks. So if you just look at the US steel sector, for instance, those stocks were up 40, 50% in the few weeks after Ukraine broke out. And there was no real fundamental boom to justify that. And now those stocks are starting to really roll over and get clobbered. The price of copper, after moving upwards in line with the 10-year treasury yield in the last few weeks, has gone this way and treasury yields have gone this way. So what is copper telling you? It's gone from $4.60 a pound to $4.05 a pound as of this morning. It's telling you that demand is weakening in the global economy, China or not. So what I would look for from a commodity perspective is it looks like, as Jacob was saying about food and energy, you're going to see these sharp cycles in both directions. What you want to see is the consensus really grow that the US is entering a sharp recession. You want to see inventories on the balance sheets of US businesses start to get liquidated, because that's going to drive down price levels. And you bet your butt that no portfolio manager with any active mandate is going to be looking to buy these commodity prices when the inflation print goes from 8.3% down to 4% year over year. That's in the wrong direction to be. And I think you're going to have an opportunity to buy the good commodity oriented companies in these industrial metal sectors at better prices in the future. So I don't like them right now. I think we answered everything. So Jacob, thank you as always. If anyone has any follow-up questions, if you'd like a copy of the deck that we presented today, if you want a copy of the video, the replay, email either of us. It's just rob@cognitive.investments or jacob@cognitive.investments. And look forward to talking to you soon.